Also share my screen. Well, yeah, thanks to everybody for joining us today. Welcome to our offices. You see those interesting pictures behind us, that's just art. It's not the protective gear which we are handing out to our staff in this crisis. It is indeed interesting times. So we saw this correlation breakdown in March, where we saw this indiscriminate sell-off of basically all risky asset classes, starting with SA equities, US equities, but in SA also SA bonds, property, preference shares, even the rand. We saw basically no place to hide, and that creates a very tough environment for a balance fund. However, then back in April, we saw this very steep recovery. So it didn't take long for the market to come back quite sharply, which is also interesting given the economic data prints which we're seeing right now. And the question which we are asking ourselves now and which we're trying to answer for you today is where to from here. So do we buy into this recovery? Is it back to normal straight from here? How do we map this V-shaped recovery in asset prices with what we think is more likely going to be a U-shaped recovery in the economic data? And you will see on our overall asset allocation that our view is that we're not out of the woods yet. So it's a more cautious stance overall. So I want to start by showcasing our our tactical asset allocation tilts. I think what stands out is the strong underweight in US and European equities, so developed market equities. That's where we are mostly concerned. The reason behind that, and I'm going to drill into these factors more in detail just now, the reason behind that is that we are concerned about valuations. We think that the very negative economic data is only about to hit us. We're also concerned about a very poor global risk sentiment. The only thing which is balanced is our financial conditions because of a lot of global central bank easing. On a net basis, however, we do arrive at a strong underweight for this asset class. We are also not too constructive for South Africa. We have a moderate underweight. There's a little bit more value in this asset class, so not as expensive as the developed world, but then obviously also still a lot of risks. We are more positive for emerging markets in general, especially emerging market small caps. Those are the asset classes which have sold off most dramatically, and where we really see very low PE ratios. And we even saw some economic positives out of China. The last PMI data print was above 50. So it seems like parts of the emerging world doesn't apply to South Africa, unfortunately, but parts of the emerging world might be further in the COVID-19 cycle. On bonds, given our cautious stance, first time in a long time, we're actually positive on more safe haven assets like US government bonds. We're negative though, so on European bonds, neutral on South African bonds, and we're positive on global emerging market bonds. It's a pure value story here. We are negative on credit globally. Spreads have widened quite a bit, but we think it's not that global credit spreads are not wide enough to justify the risks. We are neutral on most real assets, so neutral on property, preference shares, and inflation-linked bonds. I'm not going to cover that too detailed because Rupert is going to spend some time on SA-listed property. And then lastly, when it comes to the currency, at current levels, we remain negative on the rand. It's a moderate underweight. There's a lot of value in the rand. Interest rate differentials are very wide, at least at the back end of the curve. And we also see that from a purchasing power parity point of view, the rand is starkly undervalued. Having said all of that, the risks are tilted to the upside, given the economic picture or the economic data which is coming through, not just in South Africa, but more so globally, and also, as I mentioned, the quite poor global sentiment. Going to drill into US equities a little bit more in detail right now. So what you can see on the scale on the right-hand side is basically the strong underweight. You can see more on the left-hand side how we arrived there. As you know, at Prescient, we are a systematic manager, so we are completely eliminating the human biases. We are making sure that all our decisions are informed by data. And we consider this approach to be more scientific. And I think especially in those times which we are experiencing right now, it's key to remove the emotion from your decision making. So you will see on the left-hand side the 4 factors: value, economic, financial condition, sentiment. I spoke to them already. That's how we view basically all asset classes, not just globally, but also in South Africa. And at the bottom of the page, you will also see how those factors are comprised. So you see individual sub-factors. If I just look into the value section, you could see that for US equities, basically we see everything as expensive, not just the price to earnings ratio being high, the price to book ratio, but also the price to sales ratio. And even from a relative earnings yield point of view, we are negative on US equities. Let's move on to the one of those factors more in detail. I'm going to cover the price to sales ratio a little bit more in detail. So if I drill into our value section and just look into price to sales, what you can see here is that we see since after the financial crisis this steep recovery in that price to sales ratio. What we're doing on the price to sales ratio is just basically dividing current market prices by the revenue generated by all the companies over the last 12 months. So you could argue that's not very forward looking because we're looking at the past 12 months, but we do that on purpose because what we're trying to do is to use the most pure valuation metric which we can get, and we do not want to rely on an extrapolation, or we do not want to rely on forward-looking estimates of corporate analysts. Instead, we rather look at the pure price metric. How do we bake the future into a price, into our models? Well, that's basically looking at economics, financial conditions, and market sentiment. However, let's focus on the price to sales ratio for now. What you can see is that we are close to an all-time high. We are at a level which is much higher than during the or before the great financial crisis, and we're closing in basically on the all-time high of the dot-com bubble. So that's how expensive US equities are right now. Where is this ratio going to go? Well, our argumentation would be, given that we're looking at the revenue of the last 12 months, that this ratio is going to spike dramatically if prices are not going to come down. Okay, so because obviously the revenue is going to come down. So if we will not see a correction in prices, we will soon be looking at the highest price to sales ratio on track for the United States. And that's obviously from a pure valuation point of view, not a good sign. It's not only about valuation. So I want to move one step further now and look into some economic indicators. So from here, I'm going to switch into our labor market indicator, which we will see on the next page. So just zooming up here a little bit. So if we look at the US labor market, the page is just loading a second. So what we can see on the US labor market is that if I drill into the job creation, which is basically a picture of the non-farm payrolls, so basically the net job creation over the last, looking back until 1938 here, this is a monthly data print. So what you're looking here is basically the net job creation outside of the farming sector. So basically the farming sector is taken out because of the strong cyclicality. So we want to, seasonality, sorry. So we want to look at non-farm payrolls. And what you can see here is that we're seeing this extreme drop in job creation in the States, and it's really dwarfing other crises. So if I just look back a little bit into, for example, the great financial crisis, that basically disappears on this chart. Or we can also look at the burst of the dot-com bubble, or we can also look into the emerging market crisis in the late 80s. But what we can see is that this drop, which we've seen here, is really something which we've never seen before. It's 20.5 million jobs which were lost just in March. We have the lowest employment to population ratio on track since after the Great Depression. The Fed is going to release a survey today showing that 40% of all incomes below $40,000 have lost their jobs over the last 2 months. So it is really very, very concerning data. And for us, we think there's going to be a ripple effect. So markets are forward looking and will be able to look through a virus which might eventually or will eventually go away. However, we do not think that the global economy will come out completely undamaged from this sharp job loss globally. So if we just think about the economic picture a little bit more detailed, 70% of the US economy is driven by consumption. Well, if a quarter of the workforce is not working, you can only imagine what that's going to do to consumption. And with consumption declining, obviously also the businesses will start to struggle. So for us, it's not about speaking about infection rates, and it's not about making a prediction about when the virus is, call it, coming to an end. Obviously, all of that matters, but we are not experts in that space, and we don't have to be. Where we are experts is assessing the economic data and the potential impact of that, and the picture there is unfortunately not very, very positive. So that's enough with all the bad news for now. I'm going to try to hand over to Rupert now. He's going to speak about the property market locally, and yeah, we have a more balanced view in that space.
Thank you, Bastian, and thanks, Jason. So just bringing things a bit closer to home, we're going to focus first on South African property, which I think applies to all of us in some way or another. And then we'll cover the Rand, which is a controversial topic that everyone likes to talk about, but we tend to look through the noise. So on South African property, we have a neutral outlook. Some would argue that we should be extremely positive given the value case, and we don't disagree with that. Dividend yields are at the highest on record, around 20%. Relative yields and the yield spread also testing new highs. Even when earnings season comes through on the property sector, even if that earnings is cut by 50%, say, you're still going to be earning a dividend yield of 10%, which is attractive as any asset class. So on that sense, we're positive on value. But for us, at the moment, the most important factor for South African property is business sentiment. So you'll see in the sentiment section, we have a negative outlook, and split between the factors, we have a negative outlook on business and consumer sentiment and a positive outlook on investor sentiment, which is essentially our counter-cyclical indicator out of the three. So just drilling into sentiment, if we look into business sentiment, you can see that business sentiment is cyclical over time, as we would expect. So business sentiment, just to explain, is a survey of the top CEOs and other leaders of companies within the country on their outlook for businesses going forward. So it is cyclical. It averages around that 50 level, but for the last 10 or so years, it has been depressed. And we've lived through that. We all have that same mentality. I think we're all a bit sick of it by now. But what's important for us is that we look at the 6-month change of that business sentiment indicator. And that 6-month change has dipped even more negative if you look towards the right-hand side of this chart. So what that implies is that business leaders are less likely to invest into longer-term projects and are more likely to lay off employees, which in turn would translate into negative effects on the South African economy, to which property is very closely tied. Once that turns around, then we would expect the executives to start hiring again. And once the hiring begins, then salaries increase and the consumer sector will pick up. So we are looking at that closely. And if you go back up to the overview, you can see that that would be a turning point in general on our view on South African property. So if sentiment was to turn positive, then we would go to moderately overweight and take advantage of that value factor. But until it does so, we'll remain neutral on that factor. So moving on to the Rand, which again is something that's very close to home for us. We're all a bit disappointed we can no longer travel overseas. But when we do, we want to know whether our Rand is going to be worth anything at all. So we see here that we have a moderate underweight on the Rand. So what that implies is that the rand for us could depreciate further from its current levels down to say 20 rand to the dollar. We don't see it as going, at the moment at least, we don't see it as blowing out all the way to 25, but there are a couple of reasons why we see it as having still a moderate underweight. Very similar to South African property, the value sector has got extreme value within it, even with the recent rate cuts. We're seeing the carry trade still existing. So what that implies is that offshore investors, from which the rand derives a lot of its variation, offshore investors, they convert to the rand, they earn South African interest rates, and then convert back to the dollar or whatever their home currency may be, and they get that premium for taking the risk. So that premium remains extremely high, but for us, similarly to South African property, we've got negative business sentiment, but more applicable to the rand is the Prescient economic indicator. So what that entails is an aggregation of over 100 different data sets, both hard and soft data. So things like estimates as well as official publications. And that allows us to nowcast the most accurate point in time estimate of the state of our economy. So you can see in general that is a negative sign, which puts the balance of the economic section into a negative overall. So that, unlike South African property, which is a neutral, pushes this to a moderate underweight on the rand. Just drilling a bit more in detail into that Prescient economic indicator, you can see again it is cyclical, and it went through a massive downturn around the global financial crisis. It has been depressed again over the last 5 to 10 years, but we still see a lot of room to fall within South African economic activity. I don't see how that could possibly turn around, given the outlook going forward. It would take a bit of a Hail Mary pass from the presidency to encourage growth and the reignition of the economy. So for now, we expect that to remain negative. So overall, on the rand, we take a moderate underweight view. If, for instance, one of those red tiles were to change, and either economics or sentiment was to change to a neutral or a positive, then we would switch to either a neutral or an overweight on the rand, with the hopes that it would strengthen back to around the 15-ish levels. So going back to a summary of our positioning as a whole, Bastian took you through our developed market equities strong underweight, which is currently in place in our balanced fund, which only takes positions based on strong signals, not the moderate signals. And then as a mixed bag, we have an overweight towards emerging markets, an overweight signal at least. We have an overweight signal to the haven asset of US bonds. We have an underweight signal to similar growth-like assets in credit, and then neutral across real assets in South Africa, and a moderately underweight view on the rand. So just as a reminder, that means that within the balanced fund, we have an underweight within the developed market equities sector, and a neutral on property and the rand. So I think just as a reminder for us, we are a systematic team. We like to stick to the process. We make sense of the noise with all the millions of data points that we get day on day. And what we like to say is that this strategy does exactly what it says on the tin. So we're not trying to pull the wool over investors' eyes. We're very transparent on what we do and the process. And that's why we're quite happy to give updates like this on how our funds are running. So with that, I think I'll hand back to Jason just to see if there are any questions for us.
Great, thank you very much, Bastian and Rupert. There is just one question so far. If you guys have any questions, you can either maybe unmute yourself or pop through a message directly through to me, and I'll post it to Bastian and Rupert. So I've just got one question for you guys now. Over what time period do your indicators look at when you're doing tactical asset allocation, essentially?
It's a good question, especially because some of the data points which we looked in, for example, the US unemployment rate is very, very slow moving, while we looked at other indicators, and I mean, part of the indicators would be economic surprises, which basically give us daily data points, or if we look at certain indicators in the financial conditions section, it's really almost intraday data points which we get delivered. So it's a wide range of data points, some of them more slow moving. Rupert presented on the survey for South African business confidence that's only updated every 3 months. But then that is blended with a mix of indicators which are very, very fast moving and print daily data point. I think it's very important to have that mix because it's always a trade-off. The fast moving indicators obviously move faster and therefore they give you a quicker signal, but they're also prone to be a little bit more noisy. While the slow moving indicators move slower, you will not time the sell-off as well, but the signals will be with a higher hit ratio. So I think it's important to have that blend. Important also for us from our balance fund point of view. We update all of these models every day, actually a couple of times during the day. So it's not for us that we have to wait for a monthly rebalance to reflect the new view. So we are not day traders, but in case there's a new data print, let's call it non-farm payrolls, get published in the States in the Friday afternoon, we are ready to trade and implement on the minute, basically.
Okay, thanks. I just got a few more coming through here now. Which of your underweights or overweight positions are done through physical or synthetic?
Mostly depends on the asset class, obviously. So we are at Prescient, I think, good in using derivatives. So often using futures or maybe even options gives you the ability to express your view more efficiently at lower costs. There's no market impact, so we generally prefer that view. However, there are asset classes where we will also move physically. So to give you an idea, the tilt towards US equities or South African equities, that's something which we normally would do via derivatives, not necessarily always, but normally. While tilts to asset classes like credit or property preference shares, that would all be done physically. So it really depends on the asset class. I think there is a strong use case for derivatives in some asset classes. Obviously, we don't only use them for hedging or efficient portfolio management, and you must do so in a measured way. But I think generally there is a case for derivatives to tilt some asset classes.
Okay, I don't know if you guys have got, just conscious of using the portal now. Someone asked if you could show the live asset allocation. I don't know if you can navigate to that now or not.
Sure.
And maybe while just while Rupert's navigating the other question you had, Chad, I'm going to ask that one of the consultants get hold of you to update you specifically on how much alpha has been added through these tactical tilts. We can actually show you a breakdown through all the positions. It just takes a while to navigate there from here.
I'll start with the current asset allocation. So what you can see is the gray dots would be our strategic asset allocation weights. So that is basically where we are if there is a tilt, if we are not at high conviction. Okay, so what that means is that we mostly have the blue dot, which is where we are right now, sitting on the gray dot, because as you know, we only move on high conviction. So once we have a strong tilt. So the reason why we also see those gray lines on that chart, that's because those are the predefined bands in which we operate. So as said earlier, everything is strictly systematic. So once a signal gets triggered on high conviction, we will move within that predefined bandwidth. We never overrule the bandwidth. We never overrule the signal. So what you can see where we deviate now from our strategic asset allocation would be DM equities. So that's where we've moved to a slightly lower weight from 40%, sorry, from 18%, we've moved down to 15%. And then on DM income, that's where the residual now goes up. It's a small tilt and it's measured, but we do that on purpose. So we see the balanced fund as part of a core proposition. So it's not for us to take very, very brave calls and to deviate too far from the benchmark or the peer group. It's more about adding a little bit of technical asset allocation alpha on a daily basis, on a monthly basis, or basically making sure that throughout the year we will get a few bips extra. And then the second question was regarding the alpha. I wouldn't want to navigate there now. I would rather just to describe what we've achieved over the last year or two. So we generally have generate alpha on through three building blocks. It's not just tactical asset allocation. It's also an optimized strategic asset allocation, which Rupert alluded to in the beginning, which we deem as superior to the static benchmark or a static peer group. So we try to generate we try to update our strategic asset allocation frequently to make sure that this is the first part of our alpha story. The second then would be tactical asset allocation, and the third would be portable alpha. The process of portable alpha is where we basically get fixed income alpha on top of equity beta. We're doing that because we are not a big believer in stock picking. So how do those three building blocks compare performance-wise over the last couple of years? So if I look into 2019, each and every building block contributed positively. So we got a positive alpha from our TIA tilts. We got a positive in the range of between 30 and 40 bips. We got a positive alpha from our strategic asset allocation in the range of roughly 1% against the benchmark. And we've got a positive alpha from our portable alpha. If I look into 2020, we once again have a positive alpha from our strategic asset allocation. We have a slightly negative alpha, but it's very balanced. And with our underweight in DM equities, we're now breaking even in our tactical asset allocation. And we have a slightly negative alpha in our portable alpha, which is generated from our offshore portion where we suffered a little bit from spread widening.